Welcome back to the Gold Standard. Marcus Blackwell here, and we have a big one today.
Sasha Reyes with you as well, and Marcus Blackwell, big might be an understatement this week.
Gold just posted its worst weekly drop in 6 years. We're talking a fall to 44.15, and the usual war rally playbook did not show up.
Middle East tensions active and gold still sold off? That is not the typical script.
No, it is not. The Fed turned hawkish, the dollar strengthened, and institutional money headed for the exits. Goldman Sachs says the structural demand is still there, but the ETF outflows tell a more complicated story.
And that is exactly where we start. Let's think about what's driving those outflows, why the paper market is running the show right now, and what conditions would need to shift for this to stabilize.
Then we move to silver, which is doing something genuinely interesting. Paper prices are falling with everything else, but physical markets are showing supply shortfalls and rising premiums.
Chinese solar manufacturing is pulling in record imports. The Silver Act is also on the table, and policymakers pushing for strategic reserves changes has you think about silver as an asset.
We close with strategy. There is a technically oversold setup in both metals, vault infrastructure legislation worth watching, and the Fed's next communication cycle sitting as the single most important trigger for any reversal.
A lot of ground to cover here, so let's not waste any time. Let's dig in.
Right into it. Here's your look at gold's price action and what the geopolitical picture is actually telling us. Gold just posted its worst weekly drop in 6 years, not during a stock market crash, not during a recession scare, during an active Middle East conflict. That is the story this week, and it flips everything most people think they know about precious metals.
The number is $4,415.70. That's where gold settled, and the weekly loss behind that print is the kind that stops traders mid-sentence. You expect war headlines to send gold higher. That's the playbook going back decades.
And that's exactly what makes this so striking. The traditional war rally pattern simply didn't show up. Geopolitical risk is supposed to be gold's best friend, and right now that relationship looks broken.
Let's think about what actually drove the sell-off here, because it wasn't one thing.
Two forces working together, the Fed and the dollar. Rate cut expectations have been evaporating fast. The Fed stayed hawkish, the market repriced, and suddenly the opportunity cost of holding gold looks a lot less attractive.
Right. Gold doesn't pay a yield, so when rates stay high and the dollar strengthens, you're essentially paying to hold it versus alternatives that are generating real returns.
And the dollar strength is amplifying everything. A stronger dollar makes gold more expensive for buyers outside the U.S., which pulls demand from the very markets, think Asia and the Middle East, that have been supporting this bull run.
So you have institutional money repricing rate expectations, ETF outflows accelerating on top of that, and international demand softening all at the same time. Those three things hitting simultaneously explains the magnitude of the drop.
Which brings us to the Goldman call, because they came out and said, buy the dip.
During this? After that kind of weekly loss?
During this. Their argument is that structural demand for gold hasn't changed. Central bank buying, physical demand, long-run de-dollarization trends, none of that shifted this week. What shifted is sentiment.
Here's why this matters, though. Sentiment drives price, especially in the short term. Telling investors that the fundamentals are intact doesn't help much if the price keeps falling while they're watching.
Fair point, but Goldman's framing is worth taking seriously. They're drawing a line between what's mechanical and what's structural. The mechanical stuff, rate expectations, ETF flows, dollar moves, that's what's selling gold right now.
And the structural stuff is what would bring it back.
Exactly. Central banks are still accumulating. That hasn't reversed. Physical buyers in emerging markets are still there. The question is whether sentiment pressure can overwhelm structural demand long enough to shake out the weak hands.
Which is actually a real risk. If enough investors who bought gold on the rate cut thesis start exiting, you can get a feedback loop that pulls price well below what the fundamentals would justify.
And that's the uncomfortable part of the Goldman argument. They're right about the structure, but the timing of the call is genuinely uncertain. Dips can deepen before they recover.
So the paradox this week is gold is getting crushed for reasons that have nothing to do with its core function as a store of value, and yet the sell-off is very real for anyone holding it right now.
Exactly. The safe haven thesis isn't dead, but it's been suspended. The Fed is overriding geopolitics in the near term.
And that raises a question worth sitting with. If the selling is being driven by institutional money repricing rate expectations, who specifically is hitting the exit, and what the scale of those outflows actually tell us about where this goes from here?
That's the mechanical story underneath the price action. And it gets pretty specific when you look at what's happening inside the ETF market and what the dollar's strength is actually doing to positioning across the metals complex.
The data there is pretty revealing, because this isn't just a gold story.
Let's think about what's really driving that sell-off at the mechanical level, because it all traces back to the ETF story.
Right, and this is where it gets specific, because when we say ETF outflows, we're not talking about retail investors clicking sell on their phones.
Exactly. These are institutional players, pension funds, hedge funds, commodity desks. They build gold positions on one premise: the Fed would cut rates in 2026. That premise is gone.
So when the Fed signals it's holding, those positions don't make sense anymore.
Think about it this way. Gold doesn't pay a dividend, doesn't generate cash flow. Institutions hold it when they expect real rates to fall, because that reduces the opportunity cost of sitting in something that just sits there. Does that make sense?
And real rates are moving the wrong way for gold.
Sharply, so they're exiting. And here's the feedback loop that makes this worse. As they sell ETF shares, authorized participants redeem those shares for physical gold. That physical gold hits the market. Prices drop, which triggers technical stop losses.
And then the momentum crowd piles on.
Exactly. That's the feedback loop, selling that feeds more selling. Here's why this matters. Once momentum takes over, the original fundamental reason almost doesn't matter anymore. And the dollar amplifies it. Every tick higher in the dollar index makes dollar-priced gold more expensive for overseas buyers, which pulls demand from that side simultaneously.
Two headwinds hitting at once. That's the pincer.
Now, Stone put out their weekly data, and what stands out is this isn't contained to gold. The route is broad.
Across the board?
Silver, platinum, palladium, all of them down on the week, which tells you something important. When the macro trade unwinds, it unwinds everything. Institutions aren't selectively selling gold and holding platinum.
They're liquidating the whole precious metals allocation.
The whole category. So listeners who look at silver and say, well, silver has industrial demand, it should hold up. That logic is sound in normal conditions, but when institutions are cutting broad exposure, silver goes with it.
Admit temporarily.
Temporarily is the key word there.
So what does that mean for someone watching this right now? If you're looking at gold charts and wondering when the stabilizes, you're really asking, when does the Fed narrative stabilize?
Right, and right now the market is still repricing. Rate cut expectations have been pushed out repeatedly this year. Until that process settles, institutional money stays on the sidelines or keeps reducing.
Goldman's structural argument isn't wrong, though. Central bank demand hasn't evaporated. That's a real floor. But here's the thing. Floors take time to matter when a wave of paper selling is still moving through.
Good way to put it. Floors don't stop waves mid-break. They just determine where things settle eventually.
Exactly. And here's what the StoneX data reinforces. Nothing in the physical demand numbers looks like panic. This is a paper market story right now.
Which actually sets up a really interesting contrast, because if paper markets are driving everything lower, what's actually happening in physical markets, specifically for silver?
That's where the data gets genuinely surprising, because physical silver is telling a completely different story than the spot price.
Supply shortfalls, rising premiums, and China's import numbers that don't look like anything we've seen before.
The paper price says one thing, physical reality says another, and understanding that gap, the important thing to understand, might be the most important thing a precious metals investor can do right now.
That's exactly where we're going next. Now flip that on its head. While paper silver is selling off with everything else, the physical market is telling a completely different story.
And this is the contradiction worth sitting with. Spot prices are down, but dealers are reporting supply shortfalls and rising premiums on physical silver. Those two things don't usually coexist.
Right. The paper price reflects institutional positioning and rate expectations. The physical premium reflects what buyers are actually willing to pay to hold metal in their hands. When those two numbers diverge sharply, something structural is usually driving it.
So here's where it gets concrete. China's silver imports in 2026 have hit record levels, and the driver isn't jewelry or silverware, it's solar panel manufacturing. China is scaling photovoltaic capacity at a pace that requires enormous silver volumes, and domestic investors there have also shifted towards physical silver as a store of value.
Which means you've got industrial demand and investment demand hitting simultaneously in the world's largest silver-consuming country. That's not a short-term blip.
And the numbers back it up. Here's why this matters. The Silver Institute has flagged consecutive years of structural supply deficits. Mine production hasn't kept pace with demand growth, particularly from the green energy sector. So even as spot prices fall, the physical market is tightening.
Think about what that means for price discovery. If you're only watching the spot chart, you're seeing one input, institutional paper trading. You're missing the supply side entirely.
Exactly. Now let's consider the policy angle that ties this together. Congress recently introduced the Silver Act, which aims to strengthen U.S. precious metals infrastructure, specifically building strategic silver reserves and supporting domestic supply chains.
Wait, a strategic silver reserve? That's a significant policy shift if it moves forward.
It is. The U.S. strategic stockpile sold off its silver reserves decades ago. If policymakers are revisiting that, it signals they view silver as a material with genuine national security value, not just a commodity.
And the timing isn't accidental. Solar manufacturing, defense electronics, medical devices. Silver is embedded in critical supply chains.
Right.
A reserve makes strategic sense in that context.
Here's what's revealing. The Silver Act hasn't gotten much mainstream coverage, but for anyone tracking the long-term silver story, it's a meaningful data point. Legislation tends to reflect where supply stress is already being felt.
So you've got three converging signals. Physical premiums rising while spot falls, China's record import pace driven by solar scale-up, and U.S. legislators signaling strategic concern. None of those align with a bear case.
Exactly. They align with a market where the paper price is being set by short-term traders and the physical price is being set by people who actually need the metal. Does that make sense?
So what's the concrete number listeners should track? If you want a real-time signal on physical market stress, watch the silver lease rate. When lease rates spike, it means physical metal is scarce and borrowing costs to deliver are rising. That's your early indicator before premiums fully reprice.
Good point. Lease rates move faster than spot and give you a cleaner signal on actual supply tightness versus paper sentiment. That's the real indicator to watch.
And with vault infrastructure and policy legislation now entering the conversation, the next piece connects directly. There's proposed legislation specifically targeting how the U.S. stores and distributes precious metals reserves, and it raises questions that every investor holding physical metal should understand. Let's think about this policy story most retail investors are missing completely. Congress is looking at legislation to diversify U.S. precious metals vault networks beyond Fort Knox and the New York Fed.
Which sounds dry until you realize how concentrated that infrastructure actually is. A meaningful chunk of U.S. gold reserves essentially sits in two locations.
Right, and here's the important thing to understand. The proposed legislation addresses that directly. More distributed vault networks would reduce systemic risk and signal how seriously lawmakers now view physical metals as strategic assets, not just a relic on a balance sheet.
Now, speaking of government and gold in the same sentence, the Trump commemorative coin approval made headlines this week for obvious reasons. But here's what's actually worth noting. Government-backed bullion products consistently spike collector and retail demand when they launch.
The politics aside, that's a real effect. Retail buyers respond to official government branding in ways that generic rounds just don't produce.
It pulls people off the sidelines. New buyers enter through a product they recognize as legitimate, and some of them stay.
So here's why this matters. Retail demand could see a meaningful pop, and that becomes significant given where prices are right now.
Which brings us to the actual setup. Gold and silver are both oversold by several technical measures after this week's sell-off. The structure for a reversal is forming.
But forming isn't the same as triggering. Let me be clear about this. The one thing that actually moves institutional money is the Fed. A softening in their rate language, even a hint toward cuts, and you see institutional flows shift fast. So here's the concrete thing to watch. The next Fed communication cycle. Not the meeting itself necessarily, but the language around it. Any shift in tone toward accommodation is the signal that paper markets realign with physical fundamentals.
And with physical markets already tight, that gap closes quickly when sentiment turns. So, Marcus, here's the framework listeners should carry into next week. Watch the Fed's language closely. That's your signal.
Watch the Fed's words. Everything else follows from there. What a week to be watching precious metals. The core tension we kept coming back to, gold selling off hard during an active conflict, really does challenge assumptions most investors carry going in.
And here's the takeaway. When institutional mechanics and monetary policy move together, they can override almost any geopolitical signal. That's the thing to understand.
Goldman's framing of structural versus sentiment-driven selling was the distinction that mattered most this episode.
Right.
Sentiment can reverse fast.
And silver's split between paper prices and physical premiums, that tension isn't going away anytime soon, Marcus Blackwell.
Not even close, Sasha Reyes. All right, if this episode gave you something to think about, subscribe wherever you listen and drop us a review. It genuinely helps.
Questions or thoughts? Reach us at goldstandard@heymatto.com. We genuinely read everything, and your insights help us break these stories down better.
Warmly. Thanks for being here. Stay sharp, stay informed, and we'll see you next time.